Hello, good afternoon, ladies and gentlemen. Welcome to this new webinar of the Invest Horizon project that will be dedicated to business modeling for decision making, the startup business model. As you already know, Invest Horizon is a program financed by the European Commission in association with Eureka, and to facilitate Series A funding for selected deep tech companies, boosting the investment readiness and investor relations. The program is run by a consortium of partners coordinated by TechTour and including other members as EVN, BPA Funds, Meta, BWCon, Jura, and ESN. It was launched in June 2019, and since then it has supported more than 500 companies that have participated in an acceleration program of between 4 and 6 months. Well, as outlined at the beginning, today's webinar will focus on business modeling for decision making and the startup business model. And to talk about this topic, we have today an expert in this field. He's John Brennan, CEO of WestBIC, the Business and Innovation Center for West and North West region of Ireland. John is a graduate of the Marketing Institute of Ireland and holds an ACCA Diploma in Finance. He has accumulated over 20 years of experience working with high growth startups and specializes in the provision of financial modeling support to startups and scale-ups seeking investment funding to grow their businesses. Hi, John. Glad to meet you here and having you as the expert for this webinar. And as we usually do for these sessions, John's presentation will last around 30 minutes, and the audience will have another 30 minutes to ask questions and answers to the experts. Hi again, John. Happy to have you here.
Thank you.
And, over to you.
Thanks very much. So, good afternoon, everybody. Delighted to be here to talk about business modeling and with a particular focus on the startup business model. So Ruben is going to guide us through the presentation. He's got his hands on the wheel, so I'll just ask him to maybe go to the next slide. So, okay, so the business model, what is it? Okay, it includes all aspects of how the business carries out its own business. An important point is that it's not just the revenue model. It actually includes the revenue model, but it also includes many other aspects of the business, including the cost structure, the marketing channels, pricing, etc. And ultimately, what each business needs to achieve is to have a proven, sustainable framework to develop the business in a profitable and long-term sustainable manner. Moving to the next slide. So there are many types of business models out there, and this is just a collection of some of the more common types. Up on the top left there, you have the product service model, which is your traditional product that's sold to a customer, whether it's sold direct or through an intermediary. The marketplace model is a transaction-based model, typical of what you see with, for example, Amazon or Upwork, where buyers and sellers meet on a platform and they sell their products. The aggregator is where information is aggregated on one site under one particular brand name, such as Booking.com or Airbnb, and we're all familiar with that. The on-demand one is very common as well, and an example of that would be, for example, Uber. And the idea there is it offers convenience, simplicity. It's very cost effective, and in the case of Uber, for example, uses a lot of freelance labor. Subscription-based models are really popular these days. You know, your typical Dropbox, Netflix, Microsoft, Apple, all of the big tech companies use subscription-based models for part of their revenue models and their business model. Customization is becoming more common, and this is the ultimate, I suppose, marketing goal, is to service each customer exactly the way they want to be. And you can see examples of that with, for example, Nike do customization of their trainers. And recently I saw a very interesting program which details how Mini, the car manufacturer, provides customization so that each buyer can customize the color, the seating, some of the instrumentation, etc. in their car to give them exactly the product that they want. So that's something that I think is becoming much more possible with, manufacturing 4.0, etc. Virtual goods model is typical in the gaming industry, where, for example, you're buying, in some cases, selling goods that are virtual. You pay for upgrades, you pay for extra points and gifts. And again, another example of the virtual goods model are the NFTs, which again have become very popular and very topical this year. Then your broker is your traditional situation where the broker sits between the buyer and seller and offers expertise and knowledge in terms of provide info on a product, and indeed that can also be with a service. And I think one of the things you often find with businesses as they develop is that they're offering actually a mix of these different types of business models. For example, Apple will sell products, their everything from their iPhones to their MacBooks, etc. But they will also offer a subscription-based model for, their iCloud services, or whether it be Apple Music or whatever. And I think that's something that startups can also think about is, okay, we may start with one type of business model, but can we integrate other options and other types of models into our business as we progress? Not always possible at a startup stage, at the very early stage, but as you progress and as you begin to learn more about your business and your customers, there's often opportunities to integrate other types of models into the business. Moving to the next slide. So where do you start? So the business model canvas, I think, is a very good place to start, because it gives you an overview of all of the factors that you need to consider, whether it be partners, activities, the very important one, which is the value proposition. What is it that you're actually offering to the customer relationships, etc. But whatever tool you decide to use, whether it's the business model canvas or some other tool, I think the first phase that I think you need to go through, and many startups will have gone through this already, but I do think it's really important to dig deep into this process, which is the market validation, or sometimes called the commercial and market validation. In other words, test the viability of your model. To do that, you need to know who your customers are. You need to know what the needs are. You need to know what problem you're solving and how painful is that problem. How deep a problem is it for the customer? And are they willing to pay for that service? I think it's important to analyze the competition and understand how the competition operates in the marketplace. What business models do they use? And for example, can you use a different model or a better model? Because competition is really important. It's really interesting as well, because competition validates the level of demand. So it's basically saying to you that there is demand in this particular niche or in this marketplace for the product or service that you intend to offer. And it's for you to understand how best you can make your offer more attractive compared to the competitors in the marketplace. In other words, what makes your product and service distinctive in the marketplace? What can you do that makes your offer of more value and offers some distinctive factors which is more attractive to the potential buyers? And is there potential, for example, to upsell or cross-sell to additional, to secure additional revenue streams? So that's phase one, and it's all, I think, about understanding your business, understanding how best the business model meets with the customer needs, and really understanding the problem that you're trying to solve and how painful that problem is in terms of the customers. Go into the next slide. So phase two is all about, I think, testing. Once you understand what's the best model for your business in terms of developing the relationships with the customers, getting some early stage traction and some early stage sales, I think you've got to then test the model and understand what best works for you, but also what works best for the customers. And in that process, you really got to seek feedback from the customers. And I think there are many different types of customers out there, and one customer might be different to another. So I think you need to seek feedback from them. You need to listen to them. You need to understand how you can meet their needs, and then develop your business model to meet those needs and those market demands. You also need to understand the impact of, selecting a particular business model. What impact is that going to have in terms of the resources? What resources do you need? Have you the financial wherewithal? Have you the HR capability to deliver? And are there, for example, supply chain issues that you also need to address? In terms of developing the business model, and this is really important when you're talking to the investors, is you need to understand, can that business model scale? Can it go across borders? Can it travel across different market conditions so that you can actually scale? Because usually to achieve scale, you usually have to go beyond your initial target market, which might be your local market, but to expand internationally, there might be different conditions or there might be different aspects that apply to a particular market. So it's really important to understand that mix between what the customer is looking for on the one hand and how you can deliver it in terms of your resources, your ability, your capability. And when I say resources, I mean not just the HR resources, it's also the financial resources and possibly the investment that you have in the business. Moving to the next slide. I like to think that to really understand how this works in the context of your business, you have to understand it from a financial perspective. So we can work through the business model canvas. We can sort of construct a business model that we think really works, will deliver for the customer, will deliver for ourselves as a startup business. But to really understand how that works, I think you have to convert that model into practice and understand how it works from a financial perspective. And the examples that I've given here is this fictional company that we've created, which is called XYZ Limited. It's a games company. And what you can see from the summary projected profit and loss account there is it starts in 2022 and it grows the sales from 250,000 up to 8 million between 2022 and 2026, which is quite good and quite impressive. You'll also see that at the end of 2022, the EBITDA is a minus figure. So there's a minus 195,000 there. That's not the end of the world, as long as you've got investment, which we'll look at in a minute. But what you'll also notice is that as you progress and as the sales go from 250,000 to 1 million and then to nearly 2.5 million and on to 8 million, over 8 million, the balance between the revenues and the costs get more, if you like, manageable, much more sensible, and much more attractive if you're an investor looking at this business. So if looking at the business model that this company have put in place, it looks like, if we can scale the business, it's going to be quite profitable with a profit of nearly 6 million after year 5. Looking at the next slide, we can have a look at what it looks like from a cash flow perspective. So that's your profit and loss. And with our XYZ company, we're losing money in the first year, but we're turning a profit in the second year. And even that's unusual. But taking it as it is, it looks like, everything's fine. The growth in the sales is quite significant. And even as you look at the cash flow here, you can see that, taking account of what might be outstanding debtors at the end of year 5, you still have the turnover of our receipts, should I say, of over 8 million. Now, what supports all of that, as you can see in the middle there's a 350,000 euro investment, which basically is allowing the business to develop from that early stage, get the early stage traction, build the users, and convert those users from maybe freemium users into premium users and generate monthly recurring revenues, which are probably relatively low in the first stage, but achieving over 200,000 in the first year, but then growing significantly after that. And if we look at the closing cash flow figures, you can see that they're all positive at the end of the year. But what I've presented under that is a look at, and often we would drill into the monthly detail here, but just from the point of view of the presentation, I've just presented the maximum monthly and the minimum monthly cash flow requirements. And you can see there that the minimum cash flow, in other words, how low does the cash flow go on a monthly basis? And in 1 month, it goes down to 9,000 euros in year 1, which is a little bit close to the bone, if I can use that phrase. In other words, you're burning your cash very quickly. Now, that may have been at a very early stage prior to the investment coming in, or maybe not. But if we take a look at year 2, you can also see that the minimum cash flow is 30,000. And at that point, you're spending an average cash flow of 70,000. So that suggests that the business model, while it looks very advantageous and it looks like a model that's scaling really well over a 5-year period, the first couple of years are going to be tricky. Moving to the next slide. And what I try to do here is then test the model. So if we have a 20% reduction in our sales, what's the impact on our cash flow, particularly the minimum monthly cash flow? And you can see there a 20% reduction in the sales. It doesn't have a significant impact on year 1, but in year 2, we end up with a negative figure of -42 in one of the months. Now that's really important. For a startup business, you just can't go into that negative cash flow situation, because startups can survive if they're not profitable in the first couple of years, but if you have negative cash flows, that's just a really challenging position that you don't want to be in. Now, there are options that you can look at, obviously, to make sure that that doesn't happen. If we look at a 30% reduction in sales, you can see that the negatives, actually, there are negatives in both years 2 and 3, which means that, you know, based on our model as it stands, based on the resources that we have in terms of HR, the amount of money that we're spending on marketing, all the key drivers of the business, if you like, if we have a 30% reduction on our projected sales, it has a significant impact on our cash flow. And cash flow is really important for startups. It's understood that you're not going to be profitable maybe in the first couple of years, but to sustain those losses, you need to have sufficient cash. A 40% reduction, you can see then, brings the negatives out even further. So you're going out into a 4-year period where you have negatives in your cash flow. And again, that's definitely not something you want to see in your business model. And really what you've got to decide, and this is why I think the financial perspective is really important in terms of the business model that you set up, because I think this will tell you a number of things. One might be that you might have a question mark in terms of is the business model right for your business? The second thing you might be asking yourself is, do I need to raise additional funds to develop this business further? And really what I think this highlights is that you've got to examine the business model from so many different fronts, from so many different perspectives. On the one hand, it's what the customer is looking for and how best you can service the customer. On the other hand, it's about the resources that you're going to input into the business. Those resources might be financial, they might be marketing, they might be HR, etc. And the third thing is the investment. How much investment do I need? And we do need to make sure we have enough investment to cover the most likely what-if scenarios that might occur as part of the business over the first couple of years. In a startup stage, first 36 months are crucial, particularly the first 24, but really first 36 is often where you need sufficient cash to make sure the business can run in a sustainable manner. Moving to the next slide. In summary, I would say the key things to take from this presentation this afternoon is understand your business, understand how the business works, how you add value to the customer, what are the key drivers in terms of the resources and costs that are inputs into your business. And I would also say you need to review and understand how your competitors work and understand if you can use some or all of their business models for use in your business, which might in turn allow you, on the one hand, to replicate what they're doing, but on the other hand, might allow you also to add something distinctive, which will make you, which will separate you from them in the marketplace from the competition. I think it's really key that you test the business model, test and review and test again, and look at the impact of the what-if scenarios that we just discussed. I think you then move to a stage where you're implementing the business model. And again, I think it's important to seek customer feedback, to understand the trends in the marketplace, to understand changes in the marketplace. And I think during that phase, you also have to have a very close eye on your cash flows, because during that first 36 months, it's really crucial that you can have sufficient cash in the business to keep the business operational. After that, it's a case of development scale. But again, I think at that stage, you're looking at international markets, and you have to understand what are the conditions that are going to allow you to scale internationally and move from one geographical territory to another and adapt to different market conditions. And again, that often requires a further investment. So you need to understand that that might be the case and plan for that. And investment takes time. So you need to build that into your own business planning process and into your business model. So that's a quick tour of the business model process in terms of the presentation, and I'm happy to take any questions from here. Thank you.
Thank you very much, John.
Thank you, Ruben.
Thank you for your presentation. Let's see if the attendees have any question. In the meantime, you mentioned investment takes time. You have an estimate of the minimum time required for.
Well, at different stages, we've been looking at this in WestBIC recently, and we've figured out it takes usually 9 months plus to get the investments, get a term sheet on across the table for a startup. And actually, I think this discussion is really pertinent in terms of the investment process, because what we often find is that the biggest problem area is the commercial validation. And what I mean by that is that the investors are often not convinced that there's a business model there that has the potential to scale at the level that the founders and the company are saying it can scale it. In other words, they just don't believe the model. And that's where I think, the validation is so important. I think the engagement with your customers is really important from a very early stage. Even if you don't have product in the marketplace, I think that engagement can guide you in terms of understanding what the customers are looking for, understanding how customers will buy the product, and understanding what model, whether it's a straight purchase, whether it's a combination of a purchase and a subscription agreement. And that in turn actually allows you to understand how you can build in revenue streams into the business, because often, you might start off with one potential option, which might be a straight sale of a product or service to a customer. But, based on the research that you're doing, the discussions that you're having with customers, you realize that actually there's potential maybe to add in a subscription-based model to generate monthly recurring revenues, which is always very attractive. They grow slowly, but when they accumulate, they offer great potential for the business to scale in a very efficient manner.
Mm-hmm. And how we could engage these customers before selling the product? How we could find information about their expectations or?
Yeah, I think it's the old-fashioned way of trying to develop a relationship with one or two customers, and then using that those customers to maybe access other potential customers in the marketplace. You start with one. You can get a deep understanding of I think you need to get a deep understanding of how your product or service is solving the particular problem that your potential customer has. Once you can understand that, I think you can put together a business model that meets with their needs. In other words, it provides them with a solution in terms of the product, but it also meets their needs in terms of a revenue or a cost perspective. Some businesses don't like, for example, having to pay capital costs. So they don't like having to buy a product outright, and they might prefer to avail of a subscription model. And that's been one of the key features, of cloud-based services and subscription-based models, for example, with software companies. there's no capital cost, there's no upfront cost. You're buying a service, you're paying for it as you use it, and you're paying for it maybe based on the number of users that are actually using that product. So it's very efficient on the company, and they don't probably have to get approvals through finance department maybe or whatever. But so that's the kind of thing you have to understand is how, first of all, your product meets the needs of the customers, but then also understanding what's the best model for them in terms of the revenue model. How best can they pay for the service that meets their needs, but also meets your needs.
And with regard to the again the time, but for raising seed funding, and Rudy has posted this question on the chat: how long would it take to raise seed funding to test the model?
Yeah, you see, I think the startups that we're working with, usually that testing has to be done at the pre-seed stage. So generally it's before the first substantial round of funding. So let's say typically an ICT company that we work with might secure in their first substantial round of funding, it might be between 500,000 and $1 million. You need to have those questions answered before you raise that first $500,000 to $1 million seed fund. So therefore, that often means you need some early stage funding to develop that understanding and to start engaging with the customer. So again, typically you might be looking for early seed funding, 50, 100,000, which in certain circumstances can be accessed through maybe state funding opportunities in many countries. In some cases, you might get business angels to contribute to those kind of costs and support the development of the business at that stage. And of course, there's always the 3 F's, which is the family, fools, and friends. And that's not uncommon, and that's quite usual. That's where that 50,000 comes from. So there is pain at that early stage before you get that first substantial seed round in, but often, and we find particularly with, say, for example, ICT startups, you need to understand where the revenues are going to come from. Investors often won't jump in until they see early stage traction, so either a trial or some early stage customers on board. If you're talking about the, say, medtech industry, it's a totally different scenario, because often you might be talking about 3 to 5 years before the product comes to the year or comes to the marketplace. And in that case, I think usually you will have specialist investors that know that business, will understand that, they typically will jump in when you get to the MVP stage. So, but you might still need investment that's going to get you there, and that often, in our experience, comes from state supports, EU supports, etc. EIC, accelerator type funding, and other types of funding that's available nationally.
Thanks, Jan. There's another question from Khaled Abu Salem. How many customers B2B do we need to validate a business model?
Not a lot, I think. Not a lot. I think usually when we're looking, one of the key areas in the business plan that's always addressed in the B2B model is the sales pipeline. So what the investors will look for, and this is really important when it comes to the due diligence, is I think they'll look for early stage traction. So that might be just a couple of customers. That might be, it could be, in fact, a trial might be sufficient in some respects, with some negotiations going on with other customers. In other situations, it could be 2 to 3 customers, but there may not be a lot of revenues being generated. But one of the key points here is that the investors will go and do the due diligence. They will complete the due diligence. So they will say, can I talk to your customers that you're talking to at the minute? So they will get an independent view of how much the customers value the product or service that you're being offered. They'll try and understand where the pain points are for the customer and how important this product is to the customer. So I don't think the amount of revenues are necessarily the key thing, or the number of customers. You can attract investment with 2 to 3 customers, or 1 or 2 customers, and with a couple of trials on the go. But I think the key point is that it really, what happens in that due diligence process. If the customers are saying, yeah, well, this product really solves a problem for us, it really makes us either more efficient, it allows us to sell more, or whatever the case may be, that's, I think, where the investors will jump in. They will understand that there's work to be done in terms of developing this business and scaling this business. But I think what they really want to see is there is early stage demand, early stage traction, and that the customers that have engaged with the business really value the product. And you can see a pathway in terms of how this business can scale. Mm-hmm. So there are, for example, going back to the sales pipeline table again, there are 10 other customers with similar needs that you can service with this product, and then move it on from there. And it's a case of maybe at that stage looking at, okay, are there another 10 in this initial target market? If not, can we move to another target market where customers have a similar problem, and we start scaling?
Mm-hmm, mm-hmm. Perfect. And one question from Igor Turevsky. Do you always model for a downside only, or do you check the sensitivity for an upside as well?
Yeah, we do, but usually what we find with the founders, is their first stab at a model is usually the upside. So what we usually suggest to founders is they look at 3 versions of the model, which one would be an optimistic, one is a pessimistic, and then one is kind of middle of the road, and look at the implications of all 3. And funnily enough, there are implications probably associated with the optimistic one as well, which might be, we need to scale more, we need to scale quicker, we might need even more investment to reach out to other territories, because it might be about a land grab in terms of being first to the market, etc. But also on the pessimistic side, you need to understand that if you end up in that cash flow deficit scenario that we presented earlier, how are you going to deal with that? It might be that you attract more investment, but it might also be that you can change the mix in terms of the recruitment plan, or you might have to maybe change your marketing or your business development plan. But to answer the question, yeah, we would normally suggest doing 3 versions of the model: the upside, the downside, and the one in the middle. And it's interesting sometimes if you're presenting to maybe some of the Enterprise Ireland, for example, is the state support organisation in Ireland. They might take a more prudent view, so they might look for the middle ground one or the pessimistic one. The investors will want to see where this can go, what's the potential. So you're also showing them, the upside model. And it's not that you can show any investor all 3 versions, and I think it's not a bad idea, as we did there, just present a summary of some of the, you might go with the middle option, but you can also present a summary of the upside and the downside. So, there's full transparency in terms of your own due diligence in terms of doing the process, completing financial modeling, and making sure that you've made it clear to the investor that here's where we think it can go on the upside, but there's a potential risk here, and if we hit a downside, this is the impact. I think it's perfectly reasonable to take that approach of considering all options and presenting that to any group of investors.
Okay, thanks. And Jean-Remy Merry asks, according to you, what could be the best way to test the market and get the KPIs expected by investors before having our platform fully developed?
Yeah, so this is often the case that you don't have the resources to develop your platform, your product, or whatever. And so I think what you try and do is go with the crude version of the product, the MVP. You go to the potential customers. You try and develop a relationship with them. You work with them as best that you can within the context of the MVP, and try and understand and this is really useful, because I think the worst thing you can do is develop the product outright without proper engagement with the customers. So engagement with the customers at the MVP stage is really important, because you're going to get early stage feedback, which will allow you to integrate that feedback into the next iteration of the MVP. So I would start with the MVP, and I would select, maybe a small number of customers and develop that relationship, get feedback from them, understand what product is doing well, what the product is not doing well, understand if they were going to go down the road of taking this product on board as your customer, how might the revenue model work, and how best might they want a revenue model to work with them. In other words, would a subscription-based model be the best way to go, sales, per seat, etc., or would they like to buy an outright version of it, whatever the case may be. And then understanding the impact of that feedback on your business and in terms of how that can scale. So I would start small, one customer at a time. I think it'd be interesting to get feedback from a number of customers. It doesn't have to be that large, but like 3 or 4 would be really interesting, in case some of them have different views in terms of to what degree the product solves the problem or not.
Mm-hmm, mm-hmm. Perfect. And some questions from Nahel Muhammad. Are these business models or revenue models?
Yeah, there's a bit of both. It's because the revenue model, if you look at the set of projection, everything that's included in that feeds into the business model. So on the top part, you have the revenues. On the bottom part, you have all of the cost factors and the business drivers. So yeah, it's like, that's an important thing to take account of. The revenue model is not the business model, right? The business model is everything from the revenue model to the costs to all of the inputs and how you do your business as a whole. And that's why I really think it's important to convert what you have in your business model canvas into a financial context. So you see how the figures work, because the figures will show you everything. They'll show you the revenues, they'll show you the cost. You will understand the number of people that feed into your HR costs. You will understand the marketing plan and the cost of that marketing plan, and the relationship between that marketing plan as a driver of sales versus the sales. So yes, the revenue model is not the business model, but it's an important part of it. But you need to understand a lot more than just the revenues. You also need to understand the input side of the business in terms of the costs and your resources.
Mm-hmm. Okay, I think Adolfo Santoro wants to make a question. Adolfo, do you want to unmute yourself and ask your question? Hi, Adolfo.
Hi, can you hear me?
Yeah.
Okay, so first of all, thank you for your presentation. It's very clear. Well, actually, I'm interested in customization business model.
Yes.
So, how is it possible, in your opinion, to scale this type of business model? And the second question is related: is how do you choose your target customer after the customization? So basically, if your customers ask for more customization, different customization in different verticals and so on, how do you choose your, let's say, customer target customer?
Yeah. Like,
thank you.
Yes. Customization has traditionally been a difficult model to scale, because unless you can do it in a really efficient way. So I gave the example of Nike and also Mini. And that program that I was watching about the Mini being customized, the whole process was driven by robotics. So for a startup to do that, you need huge resources to put into that kind of a setup. So that's probably not feasible. And for small companies, customization has often been difficult because it's just difficult to scale it because each customer is looking for a very specialized product. Now, the only thing is, I know we have worked with companies in servicing maybe medical companies, which it's very specific type of machinery, where each model has a whole lot of, or each product has a lot of value added. And therefore, the value added can be built into the price. In that situation, customization can work. It's still a difficult one to manage, but I think it can work, and I've seen examples where it can work. But I think what it comes back to is the level of value added that you're offering to the customer. Now, if you're talking about B2B, I think that kind of model can work. If you're talking B2C, a more tricky model, I think, to scale. Because I think the B2B example I'm given there is there's huge value added with the product that's being developed specifically for the customer. But in a B2C situation, I'm not sure you can have that amount of value add, except, with really high value products. For example, if you're making, customized, really expensive watches that people will buy for 20 or 30,000, that's a totally different, high value, quality, luxury type products. Yes, your customization works there, but I think it really depends on the marketplace, the type of product you're selling, the customer, the value, the level of value add that you can build in, and the amount of profit that's in each particular sale. So it's hard to give a one-size-fits-all answer, because I do think it really depends on the product and the marketplace and the amount of value add that's in that product.
Okay, thanks.
Sorry, Ruben, I can't hear you.
Ruben, we can hear you.
Okay, there's another question from Sergey Golovanov. Sergey? I think you can...
Hi, can you hear me?
Yes.
Yeah.
Hi. Hello. You can actually read this question. It's very simple.
Yeah. Okay.
The financial model. Yes, please read it. Yes.
Financial revenues of software as a service model can be complex. Investors may not be interested to go into details and analyze the scenarios. What could be the advice to show them a bit more optimistic scenario or a bit pessimistic one?
Yeah, look, I usually, we would work with a lot of business angels. And usually what they want to understand is, if I can use the expression, the nuts and bolts of the business. Like, it's how many customers are you going to service? What's the average revenue going to be generated from each sale? So if that's like 200 customers in a year and the average revenue is 100, you just multiply the two. And that's, so we don't have to get overly complex models in place in terms of the discussions with the investors. In many ways, the simpler you can keep it, the better. So 200 customers year one, the average, sales going to be 100 or 1,000 euros. We move that to, 500 customers the following year, and then on from there. Sometimes the questions are, is there repeat business with those 200 customers? And that, if it's subscription based, yeah, sure. But if it's not, that's where you kind of have to convince maybe the customers, and you have to understand again how you can, cross-sell or resell or add new revenue streams to the business to generate more revenue per customer. And that might be an important part of the model that needs to be considered from the revenue perspective. What I would say, regardless of whether it's service or product based, I would break it down simply. How many customers? What's the average sale going to be? How are we going to scale it from one year to the next? Is there going to be recurring revenue? In other words, repeat revenue, whether that's kind of subscription based or whether it's going back to the customer because you can sell them additional new products, or whether the product has a particular life cycle or shelf life, and they're going to go back and buy more from you anyway. It's I think highlighting how all that works and how the scaling works in the context of the service and how it expands.
And another question from Adripal Singh. It is clear that one needs to understand how customers buy products or services today. What are your thoughts on introducing new business model than incumbents? For example, Salesforce versus earlier CRM software, etc.
Yeah, look, if it makes sense and if you can do it, and it's really a case of just, will the customer buy it? Does it make sense for the customer? They're not going to do something that doesn't sort of fit into their requirements. Meet their needs from a financial perspective, meet their needs from a demand perspective, etc. So, yeah, I would say yes. Look at all of the models, assess them, understand which one or two best fits your business, understand what the competitors are doing, and maybe make a decision. If it's a case that you can make a decision that another model might work for both you and the customer, the only thing you can do is test that. Get feedback, seek early feedback in terms of, would this be more attractive? Would this present certain advantages to the customer compared to what the competitors are doing at the minute? So I think by all means try it, but I think you got to test it and really understand, will it also scale across not just one customer, but across a number of customers?
Thanks. And Nahel Muhammad wants to know how to map the business model canvas to financial statements, and what comes first, prove the business model canvas with the customers or financially. Well, the first one, how to map the business model canvas to financial statements.
Yeah, that's a fair question. I would start with the business canvas and I'd sketch it out, and even in rough terms. In terms of, you can start with the value proposition is what you're offering to the customers. I think you can then look at things like, what's required in terms of the resources and the inputs into the business. So if we're going to offer this product in this manner to the customers, what's required to service that in terms of HR, in terms of investment, in terms of any overheads, etc. So I would sketch it out in the business model first. I would then move quickly, and even if it's only very rough, I would put together a financial model. And I would do it. It's amazing what you learn from the preparation of a financial model, because that's why I think it's really important to quantify business model, that you can sketch out a lovely plan on your business model canvas, but you need to convert that into a financial model. And I think an early version of that is a really good idea, because it may highlight things like, for example, the recruitment plan. If we expect to generate X amount of revenues in the first 2 years, then, okay, we need to service the clients, but how are we going to match that amount of cash flow that we have in the business, taking account of the fact that you might secure investment? And also what I will tell you is how much investment you need. Will 500,000 be enough, or do you need $1 million? So you can then, and it'll give you an idea of how this business is going to scale. So is this a business that's potentially attractive to a lot of investors and can attract a lot of investment? And the other thing it will help you understand is whether you can scale this quickly or not, and whether it's best, for example, to go out and seek more investment to allow you to scale quicker. So that's a kind of a jumbled answer, but I really think what I do first is go to the business model canvas, sketch that out first, or whatever tool you're using, sketch it out first, and then try and convert it, even if it's in a crude manner, convert it into starting off even the cash flow statement, and do it monthly and see, because once you begin to plot the costs against the revenues, and usually what happens is costs in the first year or two, the costs are accumulating at a much faster rate compared to the revenues. And that usually is what the investment is required for, is to support the scaling of the business at an early stage. So what I'm saying to you is, take your business model canvas, convert that into the financials, see what the implications are on the revenue side, see what the implications are on the cost side and in terms of the inputs. And that will allow you to understand your investment requirements, but it will also give you an understanding of how this business is going to scale. And from there, maybe we need a different business model, or maybe we need to add a different, revenue stream, or maybe we need a different recruitment plan. For example, in the early stages, instead of recruiting, we can maybe outsource some of those HR costs by using consultants or whatever. Excuse me. So I hope that answers the question.
And another question from Rahel: what comes first to prove the business model canvas, with the customers or financially?
I think both are happening at the same time. You're going to the customers, you're talking to them about your product or service, you're producing the revenue model, and at the same time you're getting an understanding of the resources that you need to deploy in the business, your HR resources, the marketing, the overheads, etc. And you're getting an understanding of, does that all work? And if once you begin to plot that out, as I said a few minutes ago, you will also get an understanding of, okay, how much investment do I need to scale this business? And typically the first 36 months are the really tricky ones. After that, if the business is progressing, you usually can scale. So I think not like you do one of these things independent of the other. I think we need to keep working on, developing the business model, understanding how that works in a financial context, understanding how it all works in the context of your customers, the marketplace, and scaling the business, and kind of having a really broad understanding of how all that's working together.
Excellent. And the two last questions, because we are reaching the end. It is right to assume that the minimum viable products only applies to tech or software startups? If not, what will be the MVP for a startup that needs investment to acquire assets or equipment before being able to offer a service?
Yeah, that's a difficult one, and I think sometimes, often what happens there is you outsource. You outsource the manufacture of the minimum viable product to another supplier. So you're not trying to put the equipment in place at an early stage. You're not trying to put all of the plant and equipment in place that you need to go to full production. And it's really common, I think, that you would outsource the development of the MVP at that stage. And that's perfectly normal. That's de-risking the process usually. So that's what I would recommend. And I would recommend that you keep doing that until you understand where this product is going. And even the first run of the product could be outsourced as well. So that's my recommendation there, if I understand that correctly. You're on mute, Ruben.
Thanks, John. And the last question from Khaled Abu Saleh. The question, if it's possible to be replied, which business model the investors prefer?
I actually think, in the ICT world, I think they like a subscription-based model, but it's slow. It can be slow to take off because you're looking at developing a customer base, and if you're talking about monthly revenues, it can be slow to take off. But you know what they like to see are those monthly recurring revenues, that you have a customer on board and the lifetime value of the customer is, you know, substantial over a number of years. That can be slow to take off. So what you sometimes find as well is that the startups will have a mixed model, which it might be there might be other revenue streams connected to that, which might be, you know, in our example there, we had a subscription-based model in that financial model, but the gaming company were also using the platform to generate advertising revenue, and they were also selling to gaming clubs and things like that. I think that's actually quite useful because our example there in the presentation was very similar to that scenario. The subscriptions were slow to build up, but over a number of years, quite significant. But to support the revenues at an early stage, they were generating revenues from advertising. They were also generating revenues from extra revenues from sales to clubs, which would be at a higher price point. So I definitely think the investors like that. And in general terms, I think investors like to see repeat sales. I think so. If you're selling a product, they like to see that there's an opportunity to upsell or cross-sell, or that there's maybe, you know, a limited shelf life on the product and you can go back and resell to the customer, or sell a new or slightly different version of the product to the customer. Repeat business, I think, is really important to kind of consider in your business model.
Excellent. Thanks a lot. Thank you very much, John, for your time, for your excellent presentation, and for replying to all the questions posted by the entrepreneurs. It's 5 o'clock Central European time, 4 o'clock in Ireland. So the time has flown, and thanks to all the attendees as well for being here today. Just a brief reminder before finishing this webinar. On the 1st of December at 2 p.m. we will organize the last pitching academy, Invest Horizon Pitching Academy of the year for the companies that participated in the Invest Horizon Accelerator. They will be able to rehearse their pitches for 5 minutes in front of coaches that will provide them with feedback on how to improve the presentation. This will be the 1st of December. My colleague Livia is coordinating the activity. And the 6th of December, we will organize the last webinar of Invest Horizon that will be focused on alternative finance for startups. You will receive the information regarding these two activities in the coming days, and we hope to meet you there, and we hope to you have enjoyed this session, and also the two events remaining. Thanks a lot.
Thanks everybody. Thanks, Ruben.
Thanks, John.